How can you as the investor get the best interest rate available when you go to purchase with a DSCR loan or refinance your options? In this video, we're going to explain exactly what goes into determining your interest rate, how you can get the best deal, and we're going to explain why DSCR interest rates are slightly higher than conventional interest rates. My name is Austin Clarence. I'm your DSCR loan expert. First things first, a DSCR loan is always going to have a higher interest rate as opposed to a conventional loan. DSCR loans are only performed and only executed on investment properties. Investment properties are always going to have a higher interest rate as opposed to a primary residence. So there's really no point in comparing a DSCR loan interest rate as opposed to a second home or primary residence, completely different loan product. In addition, conventional loans are backed by Fannie Mae and Freddie Mac, the government-sponsored entities. Because they're backed with that federal regulation, these loans perform on a much stronger basis. There's so many more guidelines and criteria and debt-to-income ratio and work history. With a DSCR loan, the lender's only looking at the projected rental income or the track record of the rental income. Therefore, they're not really as strong of a loan as opposed to conventional. Therefore, the interest rates are always going to be a little bit higher. What actually impacts mortgage rates and what causes them to move day to day? A DSCR loan is no different than any other kind of loan, with the bond market and the 5 and 10-year Treasury index making a large impact on mortgage rates. Inflation being the number one driver, and these are really ways to measure inflation with the bond market, the 5 and 10-year Treasury. So market moves interest rates from day to day. These are things that you really can't control yourself. What you can control is credit score. So of course, credit score is probably the number one driver for determining what interest rate is going to be offered to you. Lenders adjust credit score typically in brackets of 20 points. So 680, 700, 720. Every time you clear one of those 20-point brackets, you're going to get a slight improvement with your interest rate. So if you're right at the cusp, if you're pretty close to getting above that 740 or 760 figure, you may want to ask your lender if you can do a rescore, pay down a credit card to make sure you really optimize your credit score to get the best deal as possible. Another really important component for determining interest rate is going to be the down payment or the loan to value ratio. So for example, a loan that offers a 15% down payment versus a 30% down payment, really not an apples to apples comparison. The lower the down payment, the higher the interest rate is going to be. It's really as simple as that. Keep in mind, DSCR loans, especially that 15% down, are never going to have PMI. So although the interest rate is higher, it's really baking in the cost of what the PMI would offer and how it would protect that lender. The best way to think about it is the more skin in the game you have, the more protection that lender has, therefore they reward you for giving you a better interest rate. The property that you're purchasing or refinancing can also play a role. For example, a multi-unit property or a manufactured home or a condo are all going to have slightly higher interest rates as opposed to a single family home property. In addition, if the property is a short-term rental, some lenders pick up that there could be additional risk. There's more volatility with a short-term rental property as opposed to a long-term rental. So these are all things that get baked into the cake when a lender determines what your interest rate is going to be. This one is the most underrated lever that you can actually control as an investor, and most investors really don't know how it works. It's called a prepayment penalty. It sounds like a bad thing. It can benefit you in other ways. A prepayment penalty is the fee that you're going to pay to the bank or lender if you refinance or pay off your loan before that prepayment term is up. It could be anywhere from no prepayment to 1, 2, 3, 4, 5 years. Typically 2 to 3 years is the most common approach. Again, the lower the interest rate is, the higher the prepayment's going to be, and vice versa. So you may choose to take the highest prepayment of potentially 5 years to get a lower interest rate because you don't think it's likely you're going to want to explore refinance options, or because you don't think it's likely you would ever sell that property. You're basically investing in that loan, tying yourself to that prepayment penalty, getting rewarded for taking a lower interest rate with that higher prepayment penalty. So this is a judgment call and a discussion you're going to have with your lender to make sure that you select the right option that's going to give you protection for years to come, but also makes sense for you financially. You can also have a discussion with your lender about paying points or origination fees to buy down your interest rate. It's a trade-off. You're going to have higher closing costs, you're going to have a lower interest rate, and therefore a lower payment if you do decide to invest and buy points to get a lower interest rate. You can also go ask your bank or lender for a adjustable rate option. This is a program that most lenders don't have. I myself as a broker do have a few awesome outlets for 5-6 ARMs. Can't hurt to ask your lender or your mortgage broker up front, do you have any ARM options that are worth looking at? And then you can look at the trade-off and to see with that slightly lower interest rate, is it worth it as opposed to a 30-year fixed interest rate? Overall, my number one piece of advice, make sure you're actually doing an apples to apples comparison if you're comparing different mortgage lenders, because one might have a lower interest rate, but with the costs associated, like the discount points and underwriting fees, it might not be quite as good of a deal as you thought it was. So once you have everything apples to apples, you can make a much better comparison. Can't hurt to get quotes from a couple different lenders or work with a broker who can shop multiple different DSCR options so you can make sure that you're getting the best deal. If you guys want to make sure that your offer is as strong as you think it is, feel free to shoot it my way, put it in the comments here, or even email it to me. More than happy to make sure that you're getting an awesome deal with no hidden fees. My name is Austin Clarence. I'm your DSCR loan expert. Look forward to connecting.